Welcome to Real Vision. I'm Ash Bennington. I'm joined today by Neal Berger, President, Eagles View Asset Management. Welcome, Neal.
Thank you. Nice to be here, Ash. Thanks for taking the time to interview me today.
It's a pleasure to have you. I wanted to read something. I was reading over the weekend your Eagles View April 2022 note, and this quote really struck me. Quote, the core strategy or center book of the fund will actively sell short securities that the CIO, that's you, believes have been heavily influenced and distorted by global central bank monetary policy, the unprecedented injection of trillions of dollars into the financial system. Neal, with that as prologue, give us a little bit of context on the fund and what you aim to do.
So the fund has a very singular purpose, and that is to make money when markets go down, or I should say markets that I believe have been heavily influenced by the massive liquidity injection by central banks. This is primarily global bonds and global stocks. I think cryptocurrencies fall into that category, but we're not transacting in those sort of instruments. So it's mainly global stocks and global bonds. And the purpose is to make money when markets go down and try not to lose much money when markets go up. And we think that's a very valuable product for investors at this time because most people are long some form of beta, and there's really no effective hedge. People have looked at tail hedge funds, they've looked at CTAs, they've looked at single stock short sellers, but each of them has their own specific issues. So I think we've created an elegant solution that we can certainly get more into it, but that achieves the goal of helping people hedge beta in their portfolio. But at the same time, shouldn't lose much money if markets are rallying.
Yeah. One more quote that I wanted to get in here. Why this fund now, this is again from the same report, central bank policy is shifting 180 degrees in response to the threat of consumer price inflation currently running at over 7%, now over CPI, 8%, I should say, on CPI in the US. We believe there will be, and I think this is a really powerful quote, inevitable, sustained, and material negative impact upon certain securities prices for the foreseeable horizon as this abrupt monetary policy adjustment commences and starts to take hold. Neal, with that as context, give us a little bit of the framework in terms of the macro backdrop, what you see happening right now, and why you think it's relevant to market position.
Sure. So basically, we're going through the antithesis of what we had gone through over the last, dozen plus years, where previously the global central banks have been in a posture of liquidity infusion, infusing liquidity into the market, $25+ trillion, obviously accelerated with COVID, and that was to stabilize the global financial system. And, that's not without collateral effect, right? So the initial collateral effect was massive asset price inflation. We saw that in the form of stocks. We saw that in the form of cryptocurrencies, the proliferation of 18,500 different cryptocurrencies. We saw that in probably most logically and notably in the bond markets, the sovereign bond market, sovereign debt markets. I think that there was a time when there was over $19 trillion of sovereign debt that was trading at a negative nominal yield. I know that German bonds, for example, traded at negative 70 basis points. I mean, that's just not a natural market. That's just not, no rational person is buying government debt and paying 70 basis points a year for them to hold it. It was a function of an ocean of liquidity that was in the market that needed to find a home, and the collateral effect was massive asset price inflation. Now, nobody was complaining, nobody was unhappy. No market participants, no central bankers were unhappy, when markets go up because people are generally doing well. The problem is that there was a secondary collateral effect, which has now become consumer price inflation. So we're seeing, I think I wrote that quote that you mentioned back in maybe January when it was 7% or even December. But, now we're running 8% or even north of 8% in the US. I think the UK is at 10%. I think the EU is at around 8%. So we're seeing it globally. We're seeing the collateral effect being consumer price inflation, which is not a good thing. And it's something that the central banks have to respond to. So in order for me to have, wanted to launch this fund, because I'm going to use a funny word, market prices have been wackadoodle, for years. I mean, 5-year notes trading at 20 basis points, or 10-year notes even trading around that level. I don't know how low they got exactly. Like I said, 19 trillion of sovereign debt trading at negative interest rates. I mean, are wacky prices. But if something is overvalued, there's no reason it can't become more overvalued. If it's 100 times overvalued, why can't it be 1,000 times overvalued? If it's 1,000 times overvalued, why can't it be 10,000 times overvalued? So what you need is a catalyst to change that trend, if you will, and then you need the price action to support that. So whereas in the prior years, you could say, well, why didn't you start this fund 3 years ago when prices were even, or 2 years ago when prices were even more seemingly out of line? Now we have the 5-year note, the 10-year note at 285, I think is where it is, which seems like a big uptick from where it was, at just 20, 30 basis points a year or two ago. The difference is today we have a catalyst. We have the global central banks actually taking action, around the world, not just the U.S. Federal Reserve, but around the world to go from a liquidity infusion posture to a liquidity extraction posture, and doing so by ending quantitative easing, no longer re-upping each month to buy $95 billion worth of fixed income securities, by raising interest rates, and who knows what other tools they'll use, and that'll depend upon the path of inflation going forward.
Yeah, and so you also have this challenge, of course, when you're thinking about constructing a portfolio. It's the quote usually attributed to John Maynard Keynes that markets can stay irrational longer than investors can stay solvent. How do you think about that structuring process? You mentioned at the top of the show that the goal is to benefit from the liquidity extraction while not losing money when markets go up. How do you think about that? What are some of the premises that you put in as you start to unpack that challenge?
Sure. So, I like to say that I'm not in the being right business. I'm in the money making business. So economics and economic theory and all the stuff we've been talking about so far is categorized under the being right business. Now the money making business is a completely different discipline. Even though I think the price action is supporting the broader trends to be going down in asset prices, whether it's stocks, bonds, and the like, I still have to put on my trading hat. I've been in the business for 32 years. I was a proprietary macro trader for some of the most prominent firms in the world, including Millennium Partners. But it's a different discipline to actually manage the position, because markets are going to go up, markets are going to go down. It's not going to be just a straight line down. Day like today, S&P is up 50 handles. I cut my losses, so it's very tactical. And then I'll reestablish when markets are weak. So it's very tactical trading rather than set it and forget it. So at the core, I'm a trader, where I'm trading from the short side. I basically have 3 postures, which is aggressively short, short, and flat. And I'm trying to manage my risk around the core thesis of wanting to be short, but at the same time, cutting my losses very quickly when markets are not, going in my favor. And so it's the implementation is very different than the overall thesis.
Yeah, we should say we're filming here on Monday, May 23rd, 2022, for a little bit of context on what's happening in today's markets.
Sure. At 11:18. So we don't know by the end of the day what it's going to be like.
Indeed. So let's talk a little bit about the types of securities that you guys are trading.
Sure. So what we've done is we've created, like I said before, I think a bit of an elegant solution to attempt to, because it really sounds like nirvana, make money when markets go down and try not to lose money when markets go up. So how are we doing that? Okay. So first of all, as mentioned, I'm trading the center book. Okay. That's really driving the performance of the strategy. And, I'm doing the best I can to make money when markets go down and use proper risk controls to avoid losses. Losses are going to be inevitable, but to try to minimize those losses when markets are going against me. Now, in addition to that, what we did was we put some other strategies in the book, in the fund, that are solely there to support my activities. So what I mean by that is that they are what I believe is either non-correlated or asymmetric to the upside, where hopefully they should generate some profitability and some profits while I'm doing poorly. So specifically what I'm talking about are strategies like we have a pre-deal SPAC book, so it's nothing, we're not holding any SPACs through the de-SPACing event. But if we're buying SPACs at portfolio SPACs at 9.25, 9.50, if markets happen to go into a period of risk on, maybe those SPACs trade up to $10, 10.25, maybe the warrants become valuable. So we can generate a little bit of profit out of that book. But as I mentioned, it's very asymmetrical. So if markets go down, we can put the SPAC back to the sponsor at $10 a share. So it's, heads I win, tails I break even kind of thing. Another strategy in that category that we have is equity capital markets. So we have someone doing, IPO flipping, for lack of a better word, secondaries and blocks. And again, that's also a strategy that makes money generally when we're in bullish periods, because maybe the IPO window, which is shut now, will open up again for a little period of time, and some of the secondaries will perform better in the aftermarket, or there'll be some opportunities for block trades. And this is all very short term, even intraday type trading, but tends to do better when my center book trading might be more challenged. So that's hopefully going to generate some profitability for us. And then, we do have a core long equity position. It's large cap, deep value, kind of non-sexy, unloved, large cap stocks that was curated for us by, a very successful deep value manager. And the multiple on that is around 8. The PE ratio is about 8 on that portfolio versus, let's say, the S&P, which I think is around 19 right now. So, certainly if markets go down, that book will go down, but where's it going to go? It goes to 6 times earnings, 5 times earnings. I mean, this is a limited, amount of room that it's going to be able to go down if you've got these large cap, stalwart stocks, but they trade at 8 times earnings, and I'll be making a tremendous amount, through my tactical center book activity. So it's that balance that really helps us to achieve the goal of not losing much money, or any money, hopefully, if markets go up. So as I mentioned to you before the interview, we actually started this fund in April of 2021 with our own proprietary capital. And as you know, from April 21 to the end of December, the markets were quite strong. And, I took my foot off the gas pedal because I'm not a martyr. I'm not looking to short a market where the price action is not supporting my ability to make money from the short side. It becomes more difficult. So we ended up finishing up last year at up 20 basis points, which I think is a phenomenal performance in context of the fact that we're in the business of making money when markets go down. Market down 20, we're hoping to be up 40. Market up 20, we'd like to be plus or minus, 5%. If we're down 3%, market's up 20, we think that's a great performance. But last year, it happens to be that we ended up 20 basis points during the April to December period, when markets were quite strong. So we think that's just as impressive as right now, as of this moment, because I have real-time P&L, we're up 102% for the year, having made money in January, February, March, April, and now May. So we're able to, that's the objective of the fund: capitalize when markets are going down, and when the price action is supporting being able to trade successfully from the short side, and try to protect capital as best as possible during periods when markets are going up. And it's very attractive to an investor because often investors have beta in their portfolio. So if we're flat and market's up 20, well, investors don't mind because they're making quite a bit of money from their beta exposure. When they really need us is periods like this, when the rest of their portfolio is struggling. We're a very additive opportunity for them.
Yeah. So let's talk a little bit about the center book strategy. What types of securities are you shorting there? Is it predominantly U.S. equities? Are you doing currencies, commodities, international stocks?
So it's very simple. It's I don't need to get too sophisticated about it. It's futures. It's all futures. So there's a few advantages to that. Number one, the tax treatment is better because it's 1256 contracts, which is 60% long-term, 40% short-term. Secondarily, those markets are very deep and very liquid, and they trade continuously, with the exception of Friday night and Saturday. The markets are 24-hour markets, unlike, single stocks, which close at 4 o'clock and reopen at 9:30 and are subject to idiosyncratic, gap risk and that sort of thing. So we're trading very simple. I'm trading very simple products: the S&P 500 futures, 10-year note futures, 5-year note futures, Bund futures, the DAX index, maybe some Japanese interest, not so much Japanese stuff yet because there hasn't been too much excitement, but I anticipate there may be. So it's those kind of products that we're trading, that I'm trading, to keep it pretty simple. And I like it because those markets are very deep and they're continuous, and I can manage the risk very tightly. Even overnight, I'm able to do stuff if I need to.
So let's walk through each one of those. You started out with S&P futures. Give us a little bit of a sense of what you see there.
Well, interest rates are going up, markets are going down. I mean, not in a smooth manner. We certainly have plenty of counter trend rallies. I mean, from the period of March 14th of this year to March 29th, we almost had almost a 500-point rally in the S&P 500, which is where the skill comes in. I mean, I'm trying to be short and not lose a tremendous amount of money with the market going up 500 points. I think the market, if I don't have the numbers in front of me, but the S&P finished March up 3.5%. We actually finished up 6.5%. Now, if you look at the attribution of our performance, we actually did make a little bit of money in equities because I made money in the beginning of the month or the first half of the month, and then was very aggressive in terms of stopping myself out as markets were going against me, and then testing until markets sort of topped and came back down. But we made a lot of money shorting interest rates in March because interest rates, as much as stocks had a 500-point rally intra-month for the second half of the month, bonds kept going down. So we had a little bit of profit attribution from our S&P short activity, but we played good defense. But we continued to play offense in the fixed income side of the book.
Yeah, so let's talk a little bit about what you see happening right now in fixed income.
Well, clearly rates have gone up quickly, but it's still pretty wacky. I mean, when you step back, I mean, I'm not in the business of predicting the world. I'm just an observer. I can only observe what's in front of me. So we have 8% inflation in the U.S. I don't know if it's going to be transitory. I don't know if it's going to keep going higher. And by the way, I don't think anybody knows, including the Federal Reserve. We're all just guessing. So I'm not in the guessing business. I'm just in the observation business. So if I don't know which way it's going from here, I just have to assume it is where it is, which is right now 8%. And so you have a situation where you have 8% inflation. You have the central banks ceasing the quantitative easing. They're not going to be re-upping every month for $95 billion worth of purchases in bonds. And they were the largest buyer in the world to keep interest rates low, through the quantitative easing. And you have a situation where the Federal Reserve is embarking upon a tightening cycle that nobody really knows where it's going to end. So that condition is not conducive to having 2% handles across the U.S. interest rate curve. I think 5-year notes and 10-year notes are trading at about 2.85%. I mean, it's pretty absurd still that you have inflation at 8% and you have 5-year notes and 10-year notes at 2.85. Investors are signing up to get a negative 5% real return right now. And that's just not a normal condition. That's not a natural condition of events. As far as I'm concerned, that's still the hangover effect, the halo effect of the massive liquidity injection that we've had into the system for many years prior. And it takes a while for that liquidity to become extracted from the system, which is why I started a fund around this. This isn't a 2-month trade or a 3-month trade that I'm expecting to go on. I think this is going to be a multi-year process. I can't say exactly how long. People are like, how long do you think this is going to go on? Your guess is as good as mine. But I don't think it's a short-term thing because it will take a long time for the liquidity to be extracted from the system and therefore quell or squelch inflationary pressures that have started to come to the fore for the first time in 40 plus years.
When we think about policy normalization, you've talked about this in a longer term framework. What do you think that path might look like in terms of its impact on capital markets?
Sure. So as the central bank, not only in the US, but all around the world, continue to extract liquidity from the system, it doesn't take a rocket scientist to believe that asset prices will deflate, just the same way that it's 180 degrees different than when liquidity was being added to the system and you had lots of money around. That money had to find a home, and it found a home in all types of securities, whether it be equities, whether it be fixed income, whether it be NFTs or cryptocurrencies or wherever it could find a home. When liquidity is sloshing around in the system, it needs to go somewhere. It can't go under a mattress. It's just too much money. So conversely, as long as liquidity keeps becoming extracted from the system, and I suppose the central bankers will determine how long they need to do that based upon the trajectory of inflation, which I don't think they know, and I certainly don't know how long that's going to be or at what level that's going to top out. It's not even on my radar screen yet. They have plenty of room to go, and I think they know it as well. That's how long, as long as we're a liquidity extraction posture, asset prices should continue to go down.
Yeah. Something that you mentioned that I thought was really interesting is you mentioned this sort of 40-year time horizon. I think many people speak of the liquidity provision withdrawal by the Fed and by other global central banks in the context of the 2007, 2008 period, the financial crisis here in the United States. But indeed, I'm looking right now at a 10-year chart a 40-year chart of U.S. 10-year Treasury yield, and what you see is the point that you were making, peaking out in 1981 at around over 15%, and gradually rolling down until I guess looks like May of 2020 when it bottomed or thereabouts. Obviously, this is a longer term structural story in addition to what we've seen for the last 10 years. How do you think about it, and how do those two narratives intersect in your mind?
Well, I think it's logical because what you're seeing is inflationary signs for the first time in since that period of you cited the early 80s, and so again, I love to keep coming back to the fact that I'm not in the prediction business. I mean, who know? Most people are, right? They'll tell you, I think this is going to go on for 2 years or 3 years. I mean, nobody knows, So we're just gonna play it until it stops. But could inflation get back up to where it had been in the 80s? There's no reason why it can't, or the 70s. There's no reason why it can't. We've had a situation where we've had a grand experiment where I don't think there's been. I'm sure, in fact, there's never been a central bank or a situation where central banks have injected $25 trillion of liquidity into the system, and nobody really knows what the collateral effect will be from that, the full extent of the collateral effect. I mean, I don't want to be alarmist, but and I'm not predicting this, but we could see inflation higher than we've ever seen before in our lives. Or on the other hand, we could see an uptick in inflation. People who say it's transitory because of the COVID bottlenecks and the situation going on in Russia, Ukraine, and maybe it'll come down. And we just have to monitor that and watch it on an intermediate term basis. I mean, one good inflationary number here and there is not going to change the overall big picture. Inflation is going up. Central banks have to extract liquidity from the markets. As they continue to do that, liquidity becomes reduced. All asset prices will trend downward with lots of fits and starts, and counter trend rallies and things like that. But basically, the overall trend will be down, just like it's been up for the last dozen years as central banks have been adding money to the system.
Yeah. One of the conversations we have on Real Vision quite frequently is this challenge that the Fed has sort of steering between the Scylla and Charybdis here. They're behind the curve. I think it's probably pretty broadly agreed now. So you've got inflation running at over 8% on the CPI side. When you look at producer price index, it's into the double digits. And yet managing the opposite side of the dual mandate, attempting to not sort of spike the labor market in a negative way, and of course maintaining financial stability. How does the Fed, in your view, begin to balance that? Or perhaps more aptly asked, how do you begin to understand how the Fed is making that calculation? In other words, where are the pain points? At what point does the inflation become, I think, with the dominant narrative as it is today, it seems, versus moving into a bear market in U.S. equities? What do you look for when you're trying to assess what's going to happen next?
Okay, so again, I'm trying to put on my being right hat as opposed to my making money hat, because on the making money hat, I'm really just looking for price action, and I'm looking for when I get positive reinforcement by selling short and I'm making money, I know that I'm on the right track. If I'm getting negative reinforcement by selling short, I keep losing money and getting stopped out, I know I'm wrong. So that's the making money side of it. But I think the question you're asking is putting on my being right hat, which I'm often not very right, but I'll do my best. So I think that if you had to take the two, and people call them a dual mandate, it's always dynamic, right? It's never 50-50 exactly right. Dual. So right now, I think fighting the inflationary pressures, even at the expense of employment and potential recession, is superseding everything. So I think the economy can, we've had a great economy for a long time. We continue to have a great economy. I mean, the unemployment rate is in the in the mid 3% handles. So if you live in this country, that there's no bread lines. There's just lines for the new iPhone around the block. So we don't, maybe relative relatively speaking, and I mean, of course, I'm sensitive to the fact that there's a big divide between the haves and the have-nots. But, relatively speaking, even everyone in the world has generally improved their standard of living to some extent. Obviously the very wealthy to much greater extent than the lower end. But broadly speaking, we have a pretty strong economy. And the Fed has said directly, Powell has said directly that, combating inflationary pressures is his top priority, even if it means causing a recession or causing an uptick in employment. So the question is degrees. Does he want to have 20% unemployment? Certainly not. But can we go from 3% unemployment rate to 5% unemployment rate? If that means breaking the back of inflation, I think it's certainly the case that they would accept that. I think that, just speaking about the Fed a little bit, one of the things that the market is reacting to is that the market believes, it is my belief that the market believes that the Powell Fed has not been aggressive enough and has not been ahead of the curve.
Right.
And I often cite one thing, like Powell was telling us in January that they were going to, it was a sure thing that they were going to raise rates in March. And now he's saying that's basic. So, I came from a time when interest rates didn't have to necessarily wait for the actual Fed meeting to be moved. Under Greenspan, I mean, they could, and my attitude when I heard those comments, I was like, so if interest rates are going to go up, why don't you just convene a conference call between the members of the FOMC and raise interest rates tomorrow? What are we waiting 3 months for? What are we waiting all this time for? There's no magic reason why they should have to wait for a Fed meeting if they think it's appropriate that interest rates be raised. And I think it's little things like that cause the market to believe he's no Paul Volcker, you know what I mean? And be concerned that this sort of slow, methodical pace of rate increases, even though they seem to all acknowledge that they want to increase rates and that they're behind the curve. Well, if they're so behind the curve, just get ahead of the curve, I mean, so the fact that they're not doing that is spooking the market a little bit, I think, and will continue to add to the downside pressure. And ultimately, the market will perceive that inflation will take hold in a greater sense, and ultimately interest rates will be higher than had the Fed just acted extremely aggressively right away and try to squelch it before it got out of the bottle, so to speak.
Does it suggest something to you in terms of why we would see the Fed wanting to continue to telegraph with relatively long time horizons these moves? Is there some sort of moral suasion, jawboning effect? What do you think is happening there? Does it suggest something?
Well, nobody likes a stock market crash under their watch, and, for political reasons, for their own career reasons. So I think that, there's very few people, I was in elementary school when Paul Volcker was around. So, my first foray in the market was Greenspan. But, even from Greenspan on, the central banks are somewhat sensitive to trying to prepare the market for their moves and, make sure that what they do is not going to cause a crash in the market. And then they go down as the Fed chairman that caused a crash. So I think they're trying to prepare the market for what they want to do. And they're, but this particular Fed, and I certainly wouldn't be able to personally do a better job. I don't really know what I'm doing. So I'm not looking to criticize anybody, but I think the market perception is that they're a little bit overdoing it. Like, we all know interest rates are going up. Just do it already. Like, you know what I mean? Like, it's not going to be a shocking surprise. In other words, if they raise rates 100 basis points tomorrow, I do not think the market would crash. In fact, I think it's possible the market might rally on that, because the perception would be, okay, finally the Fed is getting more aggressive and understands the severity of this inflation and is getting ahead of it and is willing to, be aggressive towards fighting it, rather than being passive. Like, yeah, we'll do it once every meeting for the next 2 years. So that kind of attitude is not, it doesn't make people feel like the Fed is ahead of the game, because as they're waiting, inflationary pressures could get worse and worse.
Neal, we were talking a little bit off camera about your background. Tell us a little bit about what you were doing in the years before you started this fund.
Sure. So as I mentioned, I started in the business 32 years ago, and I started at Morgan Stanley. I was fortunate to get a job trading at a bank called Fuji Bank, which is now part of the Mizuho Group. And again, just very lucky to be placed on the proprietary trading desk. So I was trading using the bank's money, U.S. interest rate curve primarily. So short, Eurodollar futures, which is the short end, all the way out to 30-year. Did well. Obviously you learn from the market. They don't teach you this sort of thing in college, how to trade. You got to get your education from making mistakes in the market. I'd done pretty well, very well actually. And I joined what was then a little known hedge fund called Millennium Partners in 1995. Today, obviously, everybody knows the fund. And I worked at Millennium on two separate occasions during the 1990s. And in between, I worked for one of the large investors in Millennium, a family office. And I ran both an internal portfolio and started allocating that family's money out to hedge funds as the hedge fund industry started to become larger in terms of the scope of number of managers. At that point, it was still that family had been invested with, Julian Robertson and Stan Druckenmiller and Paul Tudor Jones, the old guard. There weren't that many hedge funds out there compared to today where there's maybe 10, 15,000 hedge funds. So in the late 90s, there were lots and lots of tear sheets and presentations that were being sent to the family to attract capital. And so I became the allocator for that family. So I've been allocating to hedge funds now for 25 years, a little more than 25 years, on behalf of wealthy families and myself. So we launched this firm, Eagles View Capital Management, in 2005. So we've actually been in business for 17 years. Up until recently, we've really only been allocators to hedge funds on behalf of investors, both institutional and high net worth individuals and family offices that want to invest in hedge funds. And even more specifically, we've always invested in market neutral, niche oriented, under the radar, often capacity constrained strategies that have positive expectancy, where the demand supply equation for edge and inefficiency is more fertile than playing in a field. When I started in the hedge fund business in 1995, I believe there was approximately collectively $50 billion invested in hedge funds. Today, the number is more like 4 trillion. And so that $4 trillion comes from the largest investors in the world, the sovereign wealth funds, the pension funds, state and local governments, university endowments, and many of them cannot invest less than a certain minimum ticket size. I was talking to a large sovereign wealth fund. They won't make an initial allocation unless they can allocate $250 million, which is a big disadvantage for them in the sense that they can only look at certain managers, and those managers can only be playing in the largest, most liquid markets in the world. So they all tend to gravitate towards the same large managers that we all know and love. But that means that some of the smaller, more capacity constrained strategies are not being allocated to by the bulk of the hedge fund capital. And that creates an opportunity for someone like me that's looking at strategies like congestion trading across the electricity grid, or inefficiencies in the dry bulk cargo shipping market, or natural gas basis trading. So those more niche-y sort of trading oriented strategies that don't correlate to the direction of the broader markets. And we thought that we would bring out a product that didn't correlate to the world, because there's too many products that do correlate to the direction of equities or risk on, and the world doesn't need me to create another product, another Me Too product. So and to that extent, we've won a number of awards. We've done very well, just generating truly non-correlated returns. Like, in our funds, March of 2020, we were positive. January of this year, which was a tough month for most people, we were positive. February, March, April, May so far. So we've been positive during months when markets have been more challenged, broader markets. And conversely, there's periods when markets have been very robust, and we don't participate in that. But I think that that's valuable to some investors who are just looking for something that's truly diversified and has no correlation to stocks, bonds, commodities, or other alternative investments. And because we're in the business of capitalizing on structural inefficiencies, volatility is our friend. So when there's more volatility in markets, there's more inefficiencies in markets, and hence there's more opportunities to capitalize on doing what we do. So, we are, broadly speaking, our firm, the products that we run, made about 20% last year in terms of the multi-manager products. And this year they're up 14, 15%, which is more than we should be up. I mean, that shouldn't be the long-term expectation of our product, but volatility is very high right now, and there's lots of inefficiencies in the market. So, strategies like volatility arbitrage are doing quite well. I was running these multi-manager, we still run the multi-manager products. And I think, part of the reason is obviously I'm a trader and I think I'm decent at it. And I want to do it, It's just that the world is very hard to understand over these last dozen years, as we had things that you would normally perceive as negative, where the whole world was shutting down as a result of coronavirus, but yet the markets were going up. And so the only rationale I could come up with is that central banks were infusing liquidity to keep the patient alive. And so I can't buy, you can't buy, I'm just going to use German bunds as an example. I wasn't willing to buy German bunds at 0%. It just seems irrational to buy German bunds at 0%. On the other hand, I couldn't sell them short because the trend was just too powerful. And thank God I didn't, because they went to minus 71 basis points. So I was sort of stuck between, I can't buy, I can't sell. The only thing I can do is non-correlated stuff. So we did that, and we did it pretty successfully. So that's what I've been doing, and we still have those products, and they're growing. Now we think it's timely to offer the market a product that I think is much needed, which is a beta hedge for equities, bonds, and whatever other betas they have.
So walk us through that process in your mind, from being an allocator to spinning up a fund. What did that thought process look like?
So, so I went from being a trader to being an allocator to being a trader again and an allocator. So being an allocator is actually not that much different than being a trader, right? I'm a let's call it a portfolio manager. I mean, trader connotes a little bit shorter term type of time frame, because I can't buy and sell a hedge fund intraday, for example, whereas I can with the S&P. But it's not that much different. It's essentially, I'm a portfolio manager of hedge fund securities. So when I invest in a hedge fund, I'm essentially buying that hedge fund, and if I redeem from it, I'm essentially selling that hedge fund. So it's a little bit more longer term, because often the hedge funds have quarterly redemptions and that sort of thing. So I just have to think a little bit longer term. But it's not really Apple. It's not two different disciplines. It's really very similar in the approach of understanding the edge, understanding the inefficiency that we're investing in, and then monitoring it in the context of a risk management framework, where if we have to redeem or cut the position, or the size or the full position, we do. So it's not that much different than actually trading, to being a trader of hedge fund securities, and they are designated as securities by the SEC. And then I saw this opportunity where the market needs this product right now. There aren't any other products like mine, as far as I can tell, that provide this solution. Tail hedge funds people utilize. I mean, they are very path dependent. You're constantly dealing with theta decay, the decay of the options, and you have to not only get the overall direction right, but you have to get the timing right. Because if markets go down 25%, over the next 2 or 3 year period, that's not going to be a great environment for tail hedge funds. Down 5, up 3, down 5, up 3 kind of retracement, doesn't really, you're constantly fighting against a theta decay, and your theta decay is going to not allow you to make the kind of money that you're going to make if markets just go down in over a longer term posture. Now,
Right.
If we crash tomorrow, tail hedge funds will do great, because vol will go up, and but I personally don't think. I think the risk of a crash in markets is much less than it had been in decades prior, simply because you have more short sellers in the world. In 1987, 1929, you didn't have lots of short sellers in the world, and I mean long short equities, or guys like myself who are short, the futures markets. And so when markets went down, you had a cascading effect where everybody would lose money, and you'd hit stop loss after stop loss after stop loss. Now, when markets go down, you have a contingent of people who want to cover their short positions. Maybe it's individual names they have in their book that they've sold short as part of a long short equity hedge fund, and they've hit their target. And that creates a natural buffer for the market, creates a natural bid under the market to sort of act as a shock absorber, and dampen volatility when you do have some people that are natural buyers in the market, even though over time the market may go down. I just don't think that we're going to have a crash. But what I think and what actually happens may be two very different things.
Neal, great conversation. Final thoughts, key takeaways that you'd like to leave our audience with.
Sure. So as far as my opinions about the markets, obviously I've expressed them pretty thoroughly. I think that markets will continue to go down. When I say markets, I mean bond markets, which means interest rates will continue to go up. Market interest rates will continue to go up. Equities will continue to go down. Risk assets will continue to go down. So, CDOs, CLOs, anything that fits under the category of an engineered product or risk asset will continue to go down, including cryptocurrencies. If one thing we've seemed to have proven that cryptocurrencies are yet another risk-on asset because they've been highly correlated with the overall direction of markets. So where it goes, nobody knows. So including the Federal Reserve. I can only watch the price action and continue to see how the Fed responds. And I believe, although I'm not an economist or a policymaker, I believe the more aggressive the Fed is, the quicker we'll get through this cycle. And maybe, buying the market is not even on my radar screen. I think we're in for years, but whether it's 3 years or 5 years or 10 years will depend upon how aggressive the Fed is to arrest the budding inflationary pressures that we're seeing. At the same time, volatility of markets, has certainly changed quite a bit over these last number of years. 4, 5, 6 years ago, the VIX was at 10, and seemed like it was really stuck in that, very low volatility environment, which made it hard to find inefficiencies in the market, because in markets that are not very volatile, it's very hard to find inefficiencies. Today, we're in a completely different environment where, VIX sometimes goes up over 30, sometimes goes below 20, but it's sort of trending around the 20, 22, 25 area, which is a more, historically normalized level for the VIX. And so when we have this increased amount of volatility, there'll be increased amount of inefficiencies in various markets. And so, sort of the other side of our business, not the Contrarian Macro Fund, we're continuing to find great opportunities by capitalizing on these inefficiencies in the market. And that's whether the markets go up or the markets go down. So, as you can tell, I love the business. I love talking about it. I'm passionate about it. So I'm sure people can figure out how to reach me through Google or whatever. Happy to talk about markets. Talk about our products if that's of interest to people. But that's how I right now. And I think frankly, it's a healthy thing. I think people have become a little bit spoiled. I mean, we've had 10 or 15 years of great environments, and nobody was complaining on the way up. So we don't live in a nirvana world where asset prices just keep going up infinitely, and you should have an expectation that you're just always going to make money. You have a God-given right that you always should make money. I mean, sometimes the markets go back and forth a bit, and so we've had 15, 20 years of a really overall a pretty good market. So if we have a little pain, that's not such a abnormal condition.
Neal Berger, great having this conversation about markets with you. Thank you so much for joining us.
Thank you, Ash. I really appreciate it. Thank you.
Thanks for watching, everyone.
Hi there, visionaries. If you want to get more of these kind of insights, join our community over at realvision.com. There you'll get unbiased insights and exclusive access to the very best, brightest and biggest names in finance. Be a part of our community of lifelong learners. See you there.